Hi there. In this video, we'll explain Treaty Relief Form DT Individual and how it helps prevent double taxation issues.
Imagine building a retirement fund over decades, withdrawing a lump sum and watching nearly half of it vanish before it hits your bank account. Take a British professional who has relocated overseas. They decide to draw a £50,000 lump sum from their UK self-invested personal pension, or SIP. Because they are no longer a UK resident, they might assume this transfer will be treated favorably under their new host country's tax laws. Instead, the transaction triggers a UK PAYE emergency tax code. This diagram illustrates exactly what happens next. The £50,000 withdrawal hits a rigid PAYE barrier at the border. Depending on the code applied, between 20 and 45% of the capital is instantly withheld. The expat expecting £50,000 might only receive £30,000. The UK tax system is deeply automated. Physical departure from the country does not turn off the domestic collection engine. In the absence of specific overriding instructions, the system defaults to maximum extraction. Simply changing an address on a tax return or boarding a plane is not a legal defense. HMRC requires a formal, structural intervention to release its grip on your assets. A dangerous assumption circulates among expatriates: the belief that moving to a country with a UK double taxation agreement automatically shields their wealth. International treaties do supersede domestic legislation. However, this protection is dormant. It does not exist until the taxpayer actively invokes it. Formally activating this treaty protection requires filing a specific document with HMRC, Form DT Individual. Filing this form serves one primary objective. It secures an NT, or no tax code. This code legally binds pension providers and payers, forcing them to disperse your funds gross without any UK deductions. Navigating this cross-border compliance architecture requires precision. ProTax Accountants specializes in advising expats on executing this exact strategy. Escaping double taxation requires proactive expert intervention. If you do not formally claim the treaty benefits, HMRC assumes you are not entitled to them. This flowchart shows how Form DT Individual protects wealth across two timelines. It splits into a prospective path extending forward and a retrospective path looping back. The forward-facing timeline in Part C is relief at source. Securing this issues the NT code, permanently shielding future payments before processing. The backward-facing timeline in Part D reclaims emergency tax deducted before the NT code went live. A strict rule: do not include income already taxed under PAY to avoid disrupting automated HMRC adjustments. The DT Individual framework is highly efficient when deployed correctly. It operates as a shield for future capital and a net to catch wealth you have previously surrendered. Even perfectly completed forms often fail. The primary reason is that HMRC demands absolute proof of your foreign tax residency. Self-declaration carries zero legal weight. Your host country's sovereign tax authority must physically certify your claim, confirming you are subject to their tax laws. The evidence required is highly specific to the jurisdiction. For US residents, the UK standard requires attaching IRS Form 6166. Acquiring Form 6166 is a process in itself. It requires you to first successfully file IRS Form 8802 and pay the applicable user fee. If you live in Portugal, the local tax authority will not stamp the UK form. Instead, you must provide a Portuguese Certificado de Residencia Fiscal. The Portuguese process requires an additional layer of verification. The certificate must be validated online via the government portal, or HMRC will reject the claim. In the United Arab Emirates, residents must attach a tax residency certificate issued specifically by the Federal Tax Authority. For several key jurisdictions, submitting the standard DT Individual form will result in an automatic denial. HMRC publishes bespoke, country-specific forms for residents of Germany, New Zealand, Sweden, and several other nations. These bespoke forms contain unique clauses based on that specific treaty. The German form, for instance, strictly limits relief on UK pensions to schemes where tax-relieved contributions were made for 15 years or less. Missing a single local nuance, attaching the wrong certificate, or using the general form instead of the bespoke version guarantees a rejection. The paperwork is the bridge between the two nations. Without precise, localized sovereign evidence, the international treaty remains legally void, and HMRC retains your capital. The NT code pathway is highly effective, but it is bound by strict scale limitations for pension withdrawals. If you plan to withdraw more than £100,000 from a UK pension within a single tax year, you are excluded from using Form DT Individual. High net worth transactions require a different route. You must register for the UK self-assessment system, obtain a unique taxpayer reference, and formally claim treaty relief using the HS 304 claim form. Attempting to push massive capital withdrawals through the standard form will trigger systemic alarms. High-value extraction requires a specialized compliance strategy. Section 43(1) of the Taxes Management Act 1970 starts a rigid clock for retrospective claims. You have exactly 4 years from the tax year's end to claim repayment. For example, a £20,000 overpayment in the 2021 to 2022 tax year expires exactly on April 5, 2026. HMRC will never send a letter warning you that this deadline is approaching. The burden of awareness and the responsibility to file the paperwork rest entirely on you. Once that deadline passes, the tax year is closed. Passive delay permanently enriches the UK Treasury at the direct expense of your retirement fund. Protecting your wealth requires decisive action. Form DT Individual, executed flawlessly with the correct sovereign evidence, is the specific legal instrument designed to lock in your NT code and stop the 45% PAYE meek. This precise instrument establishes the ultimate legal framework required to safely transfer your cross-border capital, entirely without domestic withholding. Please note, this content is for educational purposes only and does not constitute formal tax advice. Tax legislation is strictly subject to change. Securing treaty relief and processing complex international claims requires a specialist. Pro Tax Accountant is your strategic partner for navigating HMRC compliance. Reach out directly for expert guidance. Call 07985 689 912. Email info@protaxaccountant.co.uk or visit www.protaxaccountant.co.uk. Subscribe to the Pro Tax Accountant YouTube channel for ongoing, rigorous updates on UK corporate and expat tax strategy. Stop donating your international wealth to HMRC. Take active, legal control of your cross-border capital today.